Missed having in-person events, although this just in, I've been doing in-person events for a while. I've been out and about on some trips, but we really are just getting started in some parts of the country, being able to get together again, and it really is wonderful. So anyway, good evening and welcome to the UW Now, where we are live from New York. And on this special Founders Day episode and the Day of the Badger, which is an annual giving day where badgers come together to move the UW forward. We are celebrating that by hearing from some UW experts on timely and important topics, as we always do. So you might have seen a little less upbeat than what we've been talking about as the United States and NATO respond to the Russian invasion of Ukraine with unprecedented sanctions. Many are wondering, what is that invasion and what do these sanctions mean for commodity markets, inflation, and the global economic order? What might be the unintended consequences on the dollar's central role in the global monetary system? Does this complicate the Federal Reserve's challenge of reducing inflation without killing the recovery? And will the sanctions encourage China to align with the West, to align with Russia, or simply become more self-sufficient? All really important questions, probably not as important as the urgency that people on the ground face in Ukraine, but we are going to talk about some of these other implications tonight. We did have a panel of political scientists on the invasion. I don't remember the date, but it was the night the Badgers beat Purdue. I do remember that. So we were going to tackle these issues tonight and other audience questions with our expert panel. And I'd like to invite our first panelist up. Dana Peterson is the chief economist and center leader of the economy, strategy, and finance area at the Conference Board, which is a 501c3 nonprofit business membership and research group that conducts economic and business management research. In her work, she analyzes global economic themes having direct financial market implications, including monetary policy, fiscal and trade policy, ESG investing, and demographics. Her research covering rates, equities, credit, foreign exchange, commodities, political analysis, and asset allocation is regularly featured in national and international print and broadcast media. Most recently, as I told Dana, I was watching her on the PBS NewsHour not too long ago. She has also previously worked for Citibank as North American economist and global economist, and prior to that at the Federal Reserve Board in Washington, D.C. Please welcome Dana Peterson. And I am pleased to say Dana is a repeat offender on the show. She's been with us several times and just does a terrific job. And I'd also like to bring up our guest, Ricky Sandler, the founder of Eminence Capital, a large and successful investment management organization. Ricky was first on this program in April of 2020, and if you missed it, he was exhorting the audience to buy, which would have been a great thing to do in April of 2020. Before launching Eminence, Ricky was co-founder and general partner of Fusion Capital Management. Prior to that, he was a research analyst covering a range of industries and companies for Mark Asset Management, where he began his investing career in 1991. He served as a board member on the University of Wisconsin Foundation on its development and investment committees. He's involved with many philanthropic organizations here in New York, but we know in his heart he's a Badger, and we love that. Ricky is one of our great friends and supporters. In addition to an undergraduate degree in finance from the Wisconsin School of Business, he is also a chartered CFA. Ricky Sandler. And we have a third distinguished guest, John Peavyhouse, PhD, Vilas Distinguished Professor of Political Science and International Relations at UW-Madison. His research interests lie in international relations, political economy, American foreign policy, international organizations, and political methodology. His work examines the relationship between domestic and international politics, and he is the co-author with Joshua Goldstein of International Relations, the leading textbook on international politics. He was also the editor of International Organization, the leading journal in the field of international relations. We welcome John Peavyhouse from his home in Madison. John, and I'm suspicious because he told me 2 days ago he's a big Jayhawks fan, could not make it today. So I have a message that he has approved that I will deliver. So without further ado, we're going to start with Dana, who's going to set the stage by talking about the current economic situation and some of the impacts of recent developments in Europe, and a bit about the Fed's challenge, I think. And then I'll say a few remarks that were sanctioned by Professor Peavyhouse, and then Ricky will tell us the implications for the investment world, and then we'll take your questions. Okay? So Dana, take it away.
Great. Thank you so much, Mike, for the invitation. Thank you all for being here after work and listening to me. Okay, hopefully I won't put everybody to sleep. So I just have a few slides to just talk about what's going on in the global economy and what the Conference Board is thinking. Certainly people are tossing around the R word. That's not our base case, but certainly there are risks to the outlook. So what are the implications? So really right now what's going on is you have roughly 6 to 7 simultaneous shocks on the global economy from the war in Ukraine. So the first set of shocks are with respect to commodity prices, prices for energy, both oil and natural gas, prices for food, and prices for metals, especially precious metals that go into semiconductors. So those 4 pricing shocks are happening all at once. Meanwhile, we're having supply chain shocks because these products go into intermediate goods that get placed into finished goods and then get shipped around the world. And certainly the supply chain issue is a problem in Ukraine because unfortunately that is the location of the theater of war. And also there are supply shocks stemming from Russia because of financial sanctions on Russia. So, and also physical barriers. So for example, it's very difficult to get products to the shores, to the ports, to export. And then also it's difficult for Russia to find financing for these exports because many banks and organizations have decided they're not going to service them. So with those two things together, we have these massive supply chain disruptions that are rippling throughout the world and compounding the supply chain disruptions we're already seeing from the pandemic. Another shock has to do with, we do expect recessions both in Russia and Ukraine, and that's notable. A lot of people say, well, they're small economies, but really Russia is like the 12th largest economy on the planet. And again, these economies are so integral to the commodity supply chain that disruptions in this region are very, very serious. And indeed, when we think about food, we're very concerned that there are going to be food shortages because a lot of the food, Russia and Ukraine represent 16% of all exports of cereals. So cereals are things like oatmeal, but also animal feed, wheat, corn, and they also, most of the world's sunflower oil comes from Ukraine. And sunflower oil is used in a lot of products, a lot of food products. So we're going to see this rippling not only through your breakfast cereal, but also through meat and the candy bars you like to eat with sunflower oil in it. And the key thing is that Russia and Ukraine supply food to much of the Middle East, sub-Saharan Africa, and many parts of Asia and South Asia, Southeast Asia. And so there are already concerns, and we're already seeing political unrest in these areas. And then, I can't really see this, but I'm just kind of guessing, another shock is the migrant crisis. Roughly 4 million people, or almost 10% of the Ukrainian population, has fled the country. Many of those people are landing in Poland. At least half of them have. And so there are big issues in terms of whether or not these people will ever be able to return home. So with all of these shocks, you may think, well, these things are just kind of happening on the other side of the planet. But because we live in a global society, in a global economy, it's impacting everyone. So just a few pictures here. Here you can see that Russia and Ukraine, I think that's energy. Yeah, so Russia and Ukraine are responsible for massive amounts of energy supply to both Western and Eastern Europe. So disruptions, either from the war or through sanctions, are causing energy prices not only in Europe, but globally to spike. And then we have grains, which I mentioned. So Russia and Ukraine produce, so meaning grow 6% together of the world's grains, but they export 16%, right? So for example, if you look at China, China grows a ton of grains, but they are net importers. They're buying grains. So these economies, these two economies are really important for the global food chain, food supply. And then we have, oops, I went in the wrong direction. Oh, no, this is right. Then we have, sorry, I can't see that. Oh, I went in the wrong direction. Okay, yes, then the other issue, as I mentioned, are these supply chains where Russia and Ukraine are part of these massive supply chains that run through Europe. And in particular, Russia and Ukraine produce precious metals like gold, also nickel, neon, potash, all these different types of materials that go into things like semiconductors, right, and fertilizer. And these things, are, if they're not available, are going to make production of semiconductors, which go in everything from your car to your cell phone to your favorite gadget, so much more expensive. So what does this mean for the global economy? So I've got this eye chart up here. Basically, the way to understand this is on top, we have estimates of the impact of the war in Ukraine on GDP in 2022 and 2023. And then on the bottom, we have inflation. So if you look in the upper left-hand corner, you can see that we have a pretty sizable range of the impact on the global economy and also for the US in terms of growth. And where's that coming from? A lot of that's coming from the supply chain disruptions, but more importantly from inflation. So if you look on the chart on the bottom, you can see there are really big ranges of how much inflation could be higher due to the war in Ukraine. And so in the US, higher inflation means, well, just think about it. You might drive less. You might not go on vacation. You might buy fewer goods and services. And consumption, what everyone's buying, is 70% of the US economy. So if people stop buying goods and services because they're too expensive, that means the US economy is going to slow. So this is quite serious business. Now, everyone's talking about recession. So first I'm going to talk about it from a global perspective and then from a US perspective, and then I'll talk a little bit about the Fed, and cut me off at any point.
Keep going.
So we are not expecting a global recession. So here are our forecasts. We actually downgraded our forecasts pretty significantly for the global economy. So instead of growing 3.9% this year, we think the global economy is going to grow around 3.5%, 3.4%. But a recession, a global recession, would be characterized by growth that's under 2%. So we're not really forecasting that for this year or even next year. But there are many, many downside risks. Certainly, we could have embargoes on Russian oil. And so that could potentially send oil prices up as high as $200 per barrel, right? And so that means even more inflation and less growth. You could also have massive food shortages and political unrest all over the world, which would weigh on growth, and also further disruptions in supply chains. So there are a lot of downside risks to this, but we're not calling for a recession globally. In the US, we're also not calling for a recession, but we do believe that growth will be much slower this year relative to last year. So for example, the US economy grew by almost 6 percentage points last year. That is astounding, and that was driven in large part by fiscal stimulus, meaning I don't know how many people in this room, because you're all probably pretty wealthy, but lots of people received checks. I didn't, but, but many people received checks from the government and they spent that money, right? And so that really helped to bolster growth. And also the Federal Reserve Board cut interest rates to the zero lower bound, so anywhere from 0 to 25 basis points, where the Fed funds rate should average. And that meant many people went out and bought homes, people bought cars because financing was so inexpensive. And then also many people bounced back in terms of the labor market, and so most people were working. So those things together really helped the US economy to grow very rapidly last year. This year, we're probably looking at growth of 3%. Well, that's still pretty strong, but let me caution you. It's better to look at the fourth quarter, the final quarter of the year, rather than the whole year, because if you look at the average over the whole year, you're pulling in a lot of activity from the previous year. So if we look at the fourth quarter of 2021, the US economy grew by 7%, but we think in the fourth quarter of this year, it's probably going to grow 1.7%. So that is a material slowdown, and 1.7% is what we call potential. So that's just growth that's fast enough for the economy to get along without, causing too much inflation. So that's a really big slowdown. It's not a recession, but certainly it's a slowdown. And there are a lot of risks around that. Certainly one risk is the Federal Reserve in terms of them tightening monetary policy. So the Federal Reserve Board has already begun raising interest rates, and they may raise interest rates more aggressively than expected, than say 25 basis points per meeting. They could go 50 or 75, depending upon what they feel the trajectory of inflation is going to be relative to their 2% target. So with that, the federal funds rate could rise to 2% this year or even higher, and next year close to 3%. And if the Fed does not calibrate and do this and really telegraph what they're doing very carefully, it really could shock financial markets and also shock the consumer. Why do we care about the consumer? Because consumption is 70% of GDP, or the amount of total demand in the US economy. And so you don't want to upset the consumer, because then people will stop buying and that will slow growth. And so that's a huge risk. But it's not our base case, again, that the US will descend into recession, but there certainly are many risks around that related to the lingering effects of the pandemic across the world, feeding through inflation and supply chains to the US, as well as labor shortages in the US that are stoking inflation. And layer onto that, also the war in Ukraine and the implications through prices and supply chains to the US. Thanks, Mike.
Thank you. As always, a great tour of the economy, Dana. Well, now I wish John Peavyhouse was here, but he's not. So I'm going to say a few things. As I said, we had some dialogue back and forth today, and I think what I'm about to say is broadly consistent with what John's message would be. But, first, really what is this Russian invasion and then kind of the unprecedented sanctions that have been laid on in the wake of that mean for the global economic and financial order? And, just to level set a little bit, the globalization of the economy, or the marketization of many parts of the globe that were previously kind of operating independently, has been a big driver of economic growth over the last 30, 40 years. It really, the modern period started with the Bretton Woods Agreement after World War II, where the US and other countries agreed to a fixed exchange rate standard where currencies were tied to gold. And that really led to a period, I'd say, of US ascendancy, or at least coincided with it. There was some disruption to that in the 1970s when the US decided it wasn't going to allow convertibility into gold anymore, and that launched this era of what we call fiat currency, where currencies don't have any hard commodity backing behind them, and they're only worth what people are willing to say they're worth. The only thing you can really do with your dollars is pay your taxes. other people accept it because they have confidence in it. And the US really became the dominant currency for global trade and finance under this system. And that's due to our broad and deep capital markets and our general economic and political stability. It's not an entitlement. It has to be earned to a degree, but we were in a great position coming out of Bretton Woods and with this era of fiat currency. And then global capital markets opened substantially in the late 1970s and 80s. There's a lot of cross-border investment. It drove tons of economic development, supported, of course, by the IMF and the World Bank, kind of greasing the wheels of this marketization. And even though the US maybe was at the center and enjoyed the most benefit, and by that I mean we sort of had this free lunch where other nations, many of them, held substantial dollar-denominated reserves to intervene in currency markets and kind of backstop their own positions. And they had to get these dollar reserves by selling us stuff, oil, food, autos, and what they got in exchange were pieces of paper. Now that's our current account deficit that we always, many commentators worried about. We've got this current account deficit, it's terrible, it's terrible. Well, other people are holding pieces of paper. We got hard commodities for it. It was a great deal. But that deal might be changing. So the US was at the center, probably enjoyed more benefits, but I would say every nation benefited from trade, specialization, division of labor, and an efficient global capital market. And then when China and India and other Southeast Asian economies really came into the global market big in the 80s and 90s, it added substantially to the growth that was possible. And I think this was probably, the high water mark was maybe the 1990s. In the 2000s, we had some problems, and then the great financial crisis maybe was a catalyst for some rethinking about whether capitalism is really so great. And then I think, even though I'd say the US economy had borne in parts of the economy the pain that comes along with globalization, kind of the shrinkage of our manufacturing sector, I would say by 2015, that was for all intents and purposes over. The manufacturing that we were still in at that point, we were quite competitive. It was fairly automated as well, fairly high tech. But that was the point when we finally started to see a big populist backlash, and that manifested with a lot of tension between the US and China. And we began turning away from each other. We had the so-called trade war, which I'm not sure those are really easy to win. China was, in my opinion, rightly viewed as maybe violating intellectual property rights and some of the other rules of the game, and so I think there was some agreement to put pressure on them. They were also very successful, and so maybe you could argue some of it was other countries were a bit jealous. But it really began a pullback of globalization, sort of a corrosion of what the economic integration theme had been up to that point. And now Russia's been booted from the global trade and finance system with these sanctions. And once you weaponize the economic system you control, be careful about what the unintended consequences might be, because you probably can't run that play very often without other countries beginning to wonder who might be next and why. So it's important, the gains from trade that we achieved lifted billions of people around the globe out of poverty. But that is now going to be unwound, and the unwinding is happening kind of sadly after I think most of the transition costs were incurred. What worries me most about, what lies ahead, first, as Dana mentioned, food security and energy security could become huge issues in many parts of the world. Ukraine and Russia together, as she noted, are really important to these markets, probably punch above their weight to some extent because of their role in exports. And the scarcity of critical grains and energy could breed political chaos and create opportunities to remake global influence and alliances, especially for countries led by people who are daring and adventurous. So this is a time when you better bring your A game to diplomacy, relationship building, international relations, and have some military muscle if you need it. where will we be in 10 years? You know, I asked John Peavyhouse to think about that, and I have my own thoughts, but, you know, here's 4 different scenarios that you might think about. Things kind of go back to how they were working in 2015. In other words, global integration sort of gets restored. We pull back from the brink. We realize this is a terrible thing. And even Russia is somehow back in the global trade and finance world. I'd say that's a 10% probability, and it probably requires somebody who runs a country today isn't there anymore. Number 2 option, which I think is more likely, is Russia joins the ranks of some other nations who've been very isolated, North Korea, Iran, and the US, NATO, and China remain engaged around mutual economic and security interests and bring most of the other countries around the globe along with them. I'd say maybe that's a 40%. Another thing you could see is a bipolar or even tripolar world that emerges around NATO and its friends doing a lot more with each other and less with the rest of the world. China plus its sphere of influence, and Russia and its sphere of influence, sort of 3 different ones. And maybe a subset of that is maybe Russia and China operate more together. I think it's sort of hard to predict right now how that's going to shake out, but I'd say of the 40% probability I put around this type of world, maybe a quarter of that would be Russia and China collaborate. And then, you know, lastly would be something much more chaotic. You know, one of the problems with the sanctions, you know, the reason sanctions are imposed and could be effective is NATO has 7 times as many people as Russia does. Each side is incurring the same level of costs. All the trade that was going on between Russia and the rest of the world was benefiting both parties roughly by equal amounts. I mean, that's what trade theory would suggest. So we're incurring the same aggregate costs as Russia is, but it's just spread over 7 times as many people. But those are largely concentrated on a smaller subset of NATO. And so watch for divisions within NATO, and if that happens, you could see a remaking of alliances that are much more geographically oriented, and I won't be shocked if that happens. And, you know, hopefully that's a scenario that I wouldn't like to see, because I think the risks of war go up a lot in that scenario. So maybe we should just say very minuscule risk, but actually I'd say 10%. So those are the those that kind of worry me about the long-term fallout that we might see because of this, and those are some of the things that would be on my mind as we think about where things might go. And now I'm hoping Ricky can tell us how to invest in a world with all this going on.
Well, it was not a very optimistic picture painted by either of you.
You know, 40%, we're back to, you know, good times.
No, it was only 10% of it was good times. The other 40% is not a great scenario.
One of the 40% is okay.
Okay. So 2 years ago, we were kind of exceptionally bullish about markets. The kind of COVID had hit, and there was a lot of doom and gloom, and there were a lot of reasons to be optimistic. And while I'm not going to say I'm 180 degrees in the other direction right now, I'm probably 150 degrees. I think this is a time to be exceptionally cautious as an investor. And I'll talk a little bit about what I mean by that, and a little bit about why. Let's start with the why. You know, if you looked even before the war, you had inflation that exited 2021 at about 7%. So we were already dealing with high inflation before all the things that Dana just highlighted, and I'll throw one more in, which is the deglobalization. If companies fear supply chain disruption as they've seen, and having all of their goods produced elsewhere, a lot of that's going to going to try to nearshore or reshore or move. And that is not productive spending. That's like duplicative spending, which is also going to be inflationary. We ended the year with very high inflation. The economy, which grew very quickly, as Dana pointed out, was set to slow significantly this year, no matter what. We were rolling off the fiscal stimulus that the government had given us. In November, the Fed just started withdrawing or being less accommodative. They were tapering beginning in November. We were heading into a tightening cycle that I would have said is going to continue and still will continue until one of two things happens, until they get inflation down to near 2%, or they do significant damage to the jobs picture. I don't think that they're going to, people talk about the Fed put on the stock market, and I don't think that the Fed is going to be focused on the S&P. I think they'll be focused on jobs. And the only way to start to take the pressure off of the supply chain situation that we have is for them to slow things down. So the Fed is, even before the war, the Fed was going to be on a significant tightening path, which I think would have been problematic and a change for markets. So we would have been kind of broadly neutral sort of towards the back part of last year, thinking that the world was going to look a lot different, but maybe not terrible. When I say a lot different, we have not lived, I mean, most investors who have invested have not lived through markets with high inflation, have not lived through markets with significantly rising interest rates. And we've had falling interest rates for 30 years. Anybody that's invested post the great financial crisis has lived through a world of inflation of barely 2% and maybe modest growth of 2%. And the world going forward was going to look a lot different. Fast forward to all the things that Dana talked about around the impacts of the war, particularly the impact on inflation. And if I look at what has changed, we're now going to, instead of inflation looking like 7%, maybe some pieces being transitory and starting to roll off, we're now going to probably peak at north of 8% inflation. And we have significant pressure on that sustaining, whether you look at home prices, wage gains, even if we get some of this commodity pullback, we have other structural pressures on inflation. I think you have, food and energy obviously eat up a significant amount of budget for consumers, particularly low-income consumers. So you are already starting to see evidence of credit issues among low-income consumers, and we're at 3.6% unemployment. We have a terrific employment picture, but we're probably seeing the best of it right now. So when I look at where we were and what the war has done, and then I add in the inflationary effects of deglobalization, inflationary effects of ESG policy, it's going to be difficult for the Fed to do its job, which means it's just going to have to go further and further. That's going to have, we've had an entire economic system that's been built on ultra low interest rates. And you're just starting to see interest rates around the world. German interest rates were negative 40 basis points. They're positive 80. France was 0. They're now 120 bips. And this is just in the last month and a half. So interest rate pressure obviously takes the discount rate or the competing alternative for equities goes up. And then Mike mentioned something which I think is definitely a further risk. He talked about what does it mean when you impose economic sanctions on your partners and you freeze their money. I don't know if other countries are going to, as they look forward and look at what they're going to do with their reserves, are they going to want to hold US dollar bonds as much as they did? Are they going to want to diversify their holdings? Are they going to want to hold gold or silver or something else to protect their reserves? So I think that's further pressure on bonds from here. So you have inflation, the Fed raising interest rates, the Fed tapering and purchasing less, actually letting their portfolio run off, and then maybe other investors not wanting to hold as many. And I just think that's a picture we haven't seen in 30 years. And that's also happening at the same time where the economy is slowing. It was going to slow anyway, and I think the impacts of what we're seeing post the war mean the economy is going to slow even more. And 1.7% may not technically be a recession in the fourth quarter, but when you go from 7 to 1.7, that's not going to feel very good. And so, our view is this is a time, I'm not going to go outright bearish, but it's a time to be really careful. It's a time not to use leverage. It's a time, if you're investing, you need to own businesses that are durable and producing real cash, and most probably importantly, businesses that have pricing power. Because the best thing you could say about stocks at a time like this is some of them may be inflation protected because businesses can raise prices, and even if their nominal earnings don't grow a lot, even if their real earnings don't grow a lot, their nominal earnings can keep pace with inflation, and they can do absolutely okay. And I'd say that would be kind of one outcome. There are clearly some more downsides. Civil unrest, if there are food shortages. I think Europe is going to be in a significant challenge. Their energy picture, and I think they were very early to the ESG movement and a lot of this kind of getting off fossil fuels. And now we're seeing the impacts of that. They can't get natural gas and energy from Russia, and if you look at European natural gas is now has traded north of 30 compared to like $4 to $6 here, and every company that manufactures in Europe is going to see significant increases. They're going to see the people are going to see, consumers are going to see it, companies are going to see it, and having been closer to the crisis, they're still probably 25%, you probably know 25% of global GDP is Europe, give or take, something in that order. So there's still a big factor. China has itself imposed a number of regulatory actions at the government level, try to get a little more common prosperity, and that has been a little anti-capitalist and presented problems in China. I think on top of that, zero COVID policy in China is a significant problem for global growth. We can see that kind of trying to have a zero COVID policy is nearly impossible. And if they continue to do that, that will pressure kind of global demand for all the things that they produce. So it's a tricky picture, and one that we're running with the lowest net exposure in our hedge fund that we have since the financial crisis.
Well, at least we're consistent, right? And if I heard you right, Ricky, I think you're saying it's a great time to consider gifting appreciated stock.
And you
right?
sell it right away.
Okay. All right. That's what we do. That's what we do. We give it to Mike Stoller, and then he turns it into something fantastic. So I want to follow up. Do you feel like country risk for international investors has risen? People would always say we should have a globally diversified portfolio because there's all these great options. Has that changed a little bit in your mind with what's gone on? So,
those are like opposing comments, meaning there can still be significant country risk and you want diversity. And so number one, I think country risk has gone up. Certain regions, if you look at what's happened in China, in the past that might have been a diversifier, but if it's a diversifier to the downside, it's not a great picture. So I do think country risk is higher. I'm not sure that makes wanting a diversified portfolio any less. It just might make the return of that portfolio less holistically, or you take a different set of risks, which is, we'll concentrate in the house that's probably got the best chance of getting through this, which might be the U.S., and maybe okay, and I like that strategy better if I were allocating capital than trying to diversify away all this country risk and kind of stick with the risks and in a system where you have still a lot of entrepreneurial spirit and flexibility that will potentially be able to manage through this.
Okay, Dana, I want to turn to you and ask you a question a little bit about monetary policy, but maybe the link between monetary and fiscal policy. So there's a lot of discussion in the last 4 years or so about something called modern monetary theory, which I guess I would characterize as the belief, or at least the key insight would be, a country that issues fiat currency like we do can spend and borrow more or less with impunity if the central bank accommodates what government does. And maybe that's an overly simplistic view of MMT. Feel free to correct me. I don't know what your thoughts are about that. And kind of relatedly, does the level of national debt begin to concern you today, especially given the prospect of rising borrowing costs?
Sure. The problem with MMT is the assumption that central banks are not independent of government. And history has shown that that's a dangerous thing. And fortunately, in the US, our central bank is, for the most part, independent. Its charter was written by Congress, but Congress has, over the years, given the central bank, for the most part, independence to conduct monetary policy to affect two goals, right? Low, stable inflation, predictable inflation, and full employment, right? And those definitions have kind of morphed over time. They've become more broad. So full employment is a broad and inclusive measure, and not just one measure, right? And with inflation, the Fed has adopted something called flexible average inflation targeting. What that means is if you miss the target for a certain period of time, meaning you're below it, you're going to allow inflation to ride above the target to kind of average things out for some period of time. And that's new. Whereas before, which I think this change was made about 2 years ago, before that, the Fed would say, we're not waiting for the whites of the eyes of inflation. We're going to address any risk to inflation. So I digressed a little bit, but the point is that the central bank in the US is independent, and so that means that the central bank is not going to conduct policy to support outsized debt. Now, am I worried about outsized debt? Absolutely. And in fact, we just wrote a paper the other day about debt service on the public debt. And that's going to skyrocket, not 5-10 years from now, starting this year, right? Certainly if rates levitate, if the interest on public debt levitates with the 5-year, I think it's 10-year treasury, right? No, it's the 5-year treasury, which is affected, or its movements are a function of the Fed funds rate, what the Fed's doing, inflation and expectations, and also a third thing, which is escaping me. The balance sheet, the size of the Fed's balance sheet.
Yeah.
And we know the balance sheet's going to be run off probably starting in May, or begun the process. So I think that we should be very worried about public debt. Why? Because if you're an investor, and you can correct me if I'm wrong, would you invest in a US Treasury or a very risky corporate debt, right? You might invest in the Treasury because that's safer, but that money is just going to basically finance past obligations and interest that's accruing on the debt, as opposed to investing in a private corporation that might be producing something that's GDP enhancing, or even, subtracting money from public-private partnerships where government and businesses can work together to invest in GDP enhancing activities like infrastructure. So yes, I think we should be very worried about debt, and certainly the interest that we're going to be paying on this debt.
Yeah,
I think one of the things I would just add, the pandemic itself, if you look at why the economy turned out to be okay, it's because government stepped in. And we basically transferred that big hole, the 20 trillion that people talked about, we transferred that to governments globally, US in particular. And so I don't know that markets have repriced for that either. And I think you're right that globally government debt levels are a lot higher, potentially problematic if we have people not trusting government debt because they're engaged in what you talk about, which is just print money and spend it, and that could be problematic.
Yeah, it's like bankruptcy, right? It happens really fast when it happens, and that's what a currency crisis is like. People have faith, and then one day enough people head for the exits, and then the dam breaks. And I don't think that's going to happen in the United States by any stretch, but there's no doubt when these financing costs take up a bigger share of the budget, we're able to do fewer constructive things for people to actually move the economy forward, and people's expectations can't be met by government, and then you start getting into a tough cycle, I think, of a lot of finger pointing, and probably wouldn't be pretty. We have an audience question from James Rotenberg. What impacts will the midterm elections have on the economy?
Well, I would guess that you're going to see significant gains by the Republicans at the midterms in Congress, potentially controlling one or both houses, which is going to end up creating more of a stalemate in government. So if there is a need or a want for more fiscal spending, that's not going to happen. So I think from an economic standpoint purely, I think the government's not going to be there to cushion anything that, at least fiscally, that could start to be problematic if we get a worse economic picture than a soft landing.
Any thoughts, Dana, about midterms? Do they set up any dynamics that you find concerning?
Well, I agree. There's certainly is potential for the GOP to gain much ground. The Democrats potentially losing one or both houses of Congress. And so if you have divided government, then it is much more difficult to get anything through. But I think I just want to make a point about the Fed. We're assuming that the Fed is made up of a bunch of automatons, right, as opposed to people who are listening and watching. And so I think the Fed interest rate hikes may come in fits and starts, right, where the Fed will calibrate and watch what happens to the consumer, looking at the Conference Board's consumer confidence measure to see if consumers are starting to feel bad and if that's being reflected in consumption, like retail sales. And also monitoring financial markets. I agree, I think that, the Fed is saying it's not going to, coddle financial markets as it has done over the last, 12 odd years. But still in all, if financial markets, if there's a lot of volatility, that tends to affect consumer sentiment also. And that's often reflected in the University of Michigan's number. Sorry, I shouldn't have mentioned that.
Oh, that's okay.
They're our competitor too.
Yeah, I like your number better.
Thank you. But certainly, if people see on the news stock market, acting up, they tend to internalize that and think, well, that means I might lose my job in the future, right? So I think the Fed's going to be watching all of this very, very closely and will do everything in its power not to cause a recession. But I think the issue with inflation is that there are two sets of drivers. You have demand drivers and supply drivers. So what are demand drivers? Most people are working. You have a very strong economy. Many people still have money left over from the checks, right? And you also have very high wages. And so those are things that help stoke demand. People feel good, so they go out and they spend. The Fed can address that with its interest rate hikes. Supply side shocks, so So things like supply chains being backed up and transportation being backed up and also rising global commodity prices, the Fed cannot do anything about that, right? So I think the Fed is going to keep that in mind and do as much as it can to address the demand side elements, watching the consumer, watching financial markets, but maybe not go overboard, knowing that there's elements of inflation that are not going to go away until the pandemic is over, meaning China stops shutting down. And also there's some kind of resolution to the war in Ukraine to help commodity prices come down.
Anticipating the next question, which was, is there going to be Fed overreach? Because I agree, a lot of the inflation we see today is on the supply side, which the Fed really is not equipped to address. That's going to happen on a timeline of the pandemic and the war and energy policy, and we'll see how that plays out. Dana, do you have any thoughts about what the major elements of Biden administration fiscal policy might be? Any thoughts about what their tax policies are likely to be or spending policies and how that might play into the economy?
Well, the current administration did manage to pass an infrastructure bill, but it's kind of weak. I mean, really, I think you need like $2 trillion worth of infrastructure is broken. And they passed a bill that was something along the lines of $1 trillion, right? So you're only fixing half of what's broken and you're not building anything new. So that's all very problematic. The big policies around around human infrastructure, right, and environmental issues, and also the changes in the tax laws, like that's pretty much dead in the water, right? And you basically would need the current administration to break those pieces up and try to pass little bits and pieces of it. And also they would need to maintain the House and the Senate, because right now, everyone's shifting towards the midterm elections. It's very difficult to get anything done. Mm-hmm. So I would imagine that anything big would have to happen in the next half of the administration, and that's, again, assuming that they maintain a mandate, the Democrats maintain a mandate.
Audience question from Daniel Miller. What are the viable and sizable alternatives to the US dollar as a reserve currency? Because, of course, if we're at the center of these sanctions, where are people going to go? Well, what are the alternatives? And is it just a little bit of everything, or is there a natural alternative? And
Crypto.
Well, we have
got
some
an
crypto
investor
bulls.
back there.
Okay.
I mean, that's a great question. I mean, really, right now, there's not a really great alternative. Some of the alternatives, like the yuan, are pegged to the dollar. So you can trade in that, but you're still essentially trading in US dollar assets. But I think that, I mentioned crypto not to be funny. Seriously, crypto assets and DeFi are probably going to become like the new internet, right? Internet 2.0. At first, there's not much adoption, but then it kind of snowballs and everyone's using it. And so I think that you already have this adoption. Some economies are adopting it. For example, El Salvador, saying this is a viable asset. I mean, I wouldn't necessarily call it a currency because it doesn't quite fit all of the definitions of a currency. But certainly, it's an asset that's tradable for goods and services, and also for the thing itself. So I think that central banks really need to get ahead of this. And certainly I think it would be smart for the US to develop its own central bank digital currency. I know the Fed is kind of dragging its feet, but certainly a few weeks ago the administration put forth an executive order saying we need to look into this, right? And mainly because if you look at Russia was using these digital assets as a means to skirt the sanctions, right? So, but it's also because many more people are using this, and you don't want to have a parallel system a parallel economy of finance, because then you're going to have winners and losers and people not being included. And also, you could have runs on some of these assets. You can also have, the assets just be declared, worthless, and there's nothing backing it, right? Other than things like Tether, which are linked to some fiat currency. So I think over the longer run, there's going to be a bigger focus on these crypto assets.
Yeah, and I hope even in the shorter run, because the bigger those markets get, the stronger the forces are to keep them going. And I think having the parallel system is probably the place you don't want to be economically, but the longer they drag their feet, I think the harder it is to do something about it. Question from William Schmitz. Cyber world war, now that we're talking about crypto, is this something we should actually be worried about, and what are the capabilities, and what would you be most concerned about in a concerted cyber attack by?
I think we should be very concerned about this. In fact, the Russian president, you notice I don't use names because I'm not allowed to, so I say the president of this, or the administration, he kind of drew up this map of revenge, and basically every economy, every government that imposed financial sanctions on Russia. And also, what's been really big in terms of punishing Russia is how businesses have responded through divestments or stopping sales or pausing, banks not providing financing, pulling out, of the economy. And, with that, I lost my point. What was the question again?
Cyber risk.
Yes,
And
right. So with that, one question businesses have to ask themselves and governments have to ask themselves is, are you prepared for repercussions? And so when I think about vulnerabilities here in the US, our grid, our electrical grid really is very vulnerable. And we've seen that, a bad storm comes through, the lights go out, right? So imagine if there's a concerted attack on, our electrical grid, right? So everything that we use, we plug in, commerce would just come to a stop. And so I think that we should be very concerned about cyber risks, and certainly businesses, having their operations shut down or their intellectual property stolen. So I think this is a really big issue, and that people need to pay attention to, especially in this world where we're using things like economics and finance and computers as weapons of war.
Yeah, I was listening to a commentator over the weekend who, I think also made the point that, in some countries, the political system can impose pretty substantial costs on the population without worrying too much because they have a lot of power. And, in this country, if we go 2 hours without Wi-Fi, people are in the fetal position, and that's not a great place to be. The fetal position, or running a country that has people that are not ready for what could come. Question for Ricky from Steve Goldstein. For an individual investor, typical diversified portfolio, which Steve would characterize as 60% equity, 30% bonds, 10% cash, other. What immediate changes would you suggest? Is it stay the course, or do you think it's better to maybe be more in equities at a time like this?
I wouldn't own any bonds at all, and I probably would have some commodities, some gold and silver. I'm not personally a crypto person, but the idea behind having some protection from the currency is important to me, and so gold, silver, commodities, crypto as a piece. And I probably wouldn't own any bonds at all. And I also think within the 60% equity, I think one's got to be really thoughtful about the type of equities that you own. This is not a time to own sort of highly speculative, future TAM, exciting stories of companies that don't generate a lot of revenue and lose even more money. This is a time to own durable businesses that produce cash and are reasonably valued.
audience question for John Peavyhouse. I asked it to him earlier today, and I'm part of the audience too. So the question is, you know, a lot of people have remarked, you know, one reason to hit Russia hard with these sanctions is the deterrent effect that might have on China, who we might worry has designs on territory that, you know, in its neighborhood. And my question is, you know, does that model work as well with China? And John and I agree on this. China's 1.4 billion people. It's about 50% bigger than NATO. And again, keeping in mind the costs are going to be the same on each side, and the fact that Xi probably feels a little bit safer politically than our people do, the notion that we're going to impose those kind of costs on the trading relationship with China seems probably not like it's going to be nearly as effective. It'll be just as hard on us. That's John Peavyhouse. Thanks for joining us, John. Any other audience questions live from the crowd? Would anyone want to chime in with a question? Ricky, Dana,
Our crypto
questions.
investor.
Crypto investor. Yes, please identify yourself. Do we have a microphone? All right.
1, 2. Testing.
You could speak loud enough.
1, 2.
If we look at like the dollar, right, we've seen dollars setting low from September and highs currently for today, right?
Is it Tim?
Yeah, Tim.
So Tim's question is, do you think the best investment is to purchase future contracts in the agricultural markets because of food shortages? Look at soybeans, wheat, corn, livestock, et cetera.
Cattle, stuff like that. Yeah.
Yeah.
I would just say, I think when I made my comment about gold, silver, and commodities, I think those types of things would fit more in an investment portfolio today than they ever have, and maybe a range of things that could make up a piece of your portfolio and be a buffer. So it's going to be a cost to most people, you know, a lot of those markets, they're, you know, you want to, if you're going to invest in some of the commodity stuff, you want to stick with the markets that are not cyclical. Obviously, the food markets are not cyclical, so people have to eat. So those are interesting commodities for sure.
Well, don't you think that like if you were to purchase a contract on like cattle or livestock or wheat or soybeans, like say in 2020, like when COVID had just hit, right, those would have been extremely safe investments, right? Because we've seen percentage gains over like 40%, 30%, right? Over gold and silver, right? Which are also good markets, right? Metals is always something that's going to be long term. If we look at the average investor, when COVID had hit, we saw S&P crashing to like 18. We saw Dow Jones. We saw the tech index, which obviously offered dips. But if we compare it to like the agricultural market, there was much more gains, right? So I'm just interested why you don't want to like put your attention there.
I actually think it's a reasonable place. You know, I have mentioned I think you need to have some commodities in your portfolio. So, you know, everyone's got to sort of do what they're comfortable with, but I don't think that's a bad place for a piece of your assets. I wouldn't put all my assets in commodities.
Thank you. And then I guess if John Oros was here, he would ask you, should we be in canned goods and ammunition and farmland? That's the other question. What do you think of that?
I don't want to go there.
Okay.
I'm too much of an optimist to
All
go
right,
there.
all right. Good. We'll stick with commodities then. All right. I have no other questions coming in. We've got one back here.
I
Yes.
just want to ask the question, climate change, like where do you think this is going? And how is this forming decisions and things of that nature?
Perfect. That's a question for John Peavyhouse, which was already asked today. What are the prospects for tackling global challenges such as climate change when most of the world's oil and gas reserves are controlled by relatively authoritarian regimes who are reliant on them, those revenues from carbon use? John's answer: most think this is going to continue to spur us to more green sourcing of energy. It's not going to happen overnight, and in the short run, we're likely to increase fossil fuel usage, but it will be like the 70s potentially. Let's find ways to conserve, et cetera, if we're going to be held at ransom by other countries where our interests might not be aligned. The fact that the UAE and Saudi Arabia won't take our phone calls right now about increasing production is a huge problem. People aren't paying enough attention to that. That said, ultimately, does Saudi Arabia want to place their eggs in the US basket or the Russian basket, where they'd have to figure out how to get along with Iran? Unclear. But I think it's very difficult to tackle climate change in a world that splinters, because then we're not going to have a unified global approach, and the free rider problem is going to be terrible. So that's why I hope the scenario where, at least if we can get back on side with China better than things were headed as a result of this, would be the best thing that could come out of it, I guess, potentially. But if things splinter into several groups, that would make me a little bit more pessimistic.
I think the climate stuff is already impacting what's happening with the oil markets. Companies are not willing to invest in production. If you look, every major endowment and pool of money is pulling out of investing in this stuff. We need it, but nobody's willing to invest in it. We need it for a long time. I think that it certainly presents a challenge to tackle climate change by kind of shaming investment in a resource we need actually to build the green systems. Like we can't even build the green energy sources without the fossil fuels, let alone live and drive every day. So it's exacerbating. And I talked a little bit about what's happening in Europe. I think that's part of why Europe is feeling so much pain right now on energy costs.
Would you advise the UW Foundation to divest from fossil fuels?
Definitely not.
Dana?
I don't give investment advice.
Wow. Now that is a Dana for president. All right.
I think the UW Foundation should do, from an investment standpoint, what's in its investment interest economically, instead of trying to make a statement.
Thank you. I think that's going to wind up our program tonight. We've got a wonderful reception upstairs. I'm hoping Dana and Ricky can hang around a bit and take some informal questions. I'll call John Peavyhouse and get him on the line if you got something for him. But thank you all for coming out tonight. This was really a lot of fun. And Dana, thank you for doing this. You've been with us at least 4 times. I think you're approaching the Nasia Safdar standard. She was our COVID expert. And Ricky, great to have you with us again, too.
Thanks.
Pleasure. Thanks, everybody.
Nice.
You can try, but you'll never stop a badger.
All right.
Because
That
we
was
badgers
fantastic.
are born with
Thank you.
curious
I'm
minds
sorry,
and endless heart.
there was no
When we see a curve in the road,
slides.
we speed up. When there are mask shortages for first responders, we make our own supply chain. When there's a world on pause, we sharpen our claws. Through thunder, fire, and pandemics, we'll keep going. Because after all, you can't stop a badger.